Welcome back to the Elated Real Estate Channel. Today I've got part two of interest rate hacks. Very exciting topic. A lot of people are like, man, these rates are so high. I just want to know how I can save money. So clearly, this is one of a few strategies. This is not a new topic though. I mean, it's been around for a while, and sort of people forget that we used to do some of these strategies when rates were higher, and certainly when they were a lot higher, they were more prevalent. So anyways, just a reminder, please, if you haven't already, we really would love for you to subscribe. And even more than that, we would love for you to share and tell your friends about us. So hopefully they can become subscribers and they can tell us relevant topics. Reach out to us if you have specific questions about Georgia real estate. We'd love to hear them. You can reach us via email. There's a link provided for a Calendly consultation. It's free. It's no obligation. If you have questions about your specific information, of course, we would love to try to help. We're going to be posting a lot of new content each week, and so we'd love to have you in the loop on what we're talking about. So let's get started with our topic, though. With our today's part two is our rate hacking strategy topic. We're going to just briefly talk today about ARMs or adjustable rate mortgages versus fixed. Remember last time we talked about extra payments and biweekly payments. So if you missed that, we hope you'll tune into part one. Please do so. And if you have questions about that one, we hope you'll reach out as well. But I put together two slides, and I used today's market rates. We're in December of 2023, near the end of the year. We hope rates are going down. This makes sense whether they do or not, but we certainly want to give an example of today's interest rates. And the quoted rate today, when I put the slide together, was 7.09. You can probably find a rate a little bit lower than that, but using that as a baseline of comparison, that's the average market rate for today at 7.9% on a 30-year fixed rate with the loan starting in December this month of 2023. And we're going to use a $400,000 loan amount. Our average sales price in November of 2023 was right around 500,000. So here in Atlanta. And this breaks down the different things that you could expect that loan to look like. Your monthly principal and interest payment would be $26.85 with these terms. Your total interest paid over the course of the loan, this is just interest, would be $566,755. If you follow me across to the next, your total cost of the loan would be 400,000 plus that 566, which gives you that 966,755. And then that rate would be, or that mortgage would be paid off 30 years from now. So that's how that looks. Comparatively, you'll see let's talk about the key points here. What changed? Loan term is the same. It's a 30-year loan. It's a much lower rate. And why is that? It's because the rate's locked in for a 5-year period. This is a 5-year ARM. It's what's called a 5-1 ARM. And basically all that does is it adjusts one time in 5 years. So that's a 5-1 ARM. And what that means is you get a lower rate for that 5-year period. And you can see that reflected here. If you look at 6.42, 6.42, and then that monthly payment you can see is 2,507 compared to 2,685. So you'll get about $170 of savings per month. Your rate's a little bit lower, so your payment's a little bit lower. You pay far less interest, about $64,000 less interest over the course of the loan should you stay in that loan, assuming it doesn't adjust to some higher interest rate. Well, the strategy here and the opportunity here is a lot of people aren't in their home for more than 5 years, or some people think that rates will go down, or they'll be getting a larger home or a different location. And so when it makes sense to do a 5-1 ARM, and you feel like you're okay taking the risk of your job being the same or it's stable during that time, and the market being stable enough to take a risk like this. And say your plan is to be there for 3 years, and you think that in 3 years you'll be moving anyway. Maybe you're transferring to another part of the country, or you'll need a bigger house, or whatever the case may be. You're willing to take a 5-year ARM at a lower rate for the lower payment and the lower interest rate. So you'll be paying less interest even in that shorter period of time. Or if you think rates are going down, it can be a way to get a lower rate for the time being until rates go down. If rates go down below, let's say 5.5, you should begin to think about refinancing at that time. We'll talk about that in a later channel broadcast, but know that these are ways to save money on interest. And if you can stomach the risk that you take of an adjustable rate after a 5-year period, it might make sense to do that. So hopefully that's been helpful and a good explanation of what an adjustable rate loan can be and a good way to get a lower interest rate in a higher interest rate environment. Thanks for tuning in.